Okay, traders, a different kind of video today. We're ending January, ending the week on a green note. I wanted to go over this bull flag that I traded on the short side. Now, most people traditionally look at the bull flag and they look at it as a bullish signal. I have learned over the years, especially when a ticker is overbought, to avoid buying the break of the high of the day. Now, why is that? Well, let's take a look at this bull flag, VIAV. This ticker was up on a buy rating, on some decent earnings, but it was already up from nearly $10 up towards $12.91. Now, there's a few variables we look at, right? A bull flag when a stock is not overbought may be a more bullish signal, but when a ticker is overbought already, RSI is over a 70, we have above average volume, we're gapping up higher, and we're hitting a resistance level. Looking left of the chart, on the past chart history, it is a pocket pair ace hand that is developing for a short, in my opinion. And I've seen this time and time again work. Now, what happens typically with amateur traders right here? So what they see is a stock making higher lows, which it did multiple times, and it squeezing tighter up towards resistance, but we had multiple resistance levels on this. We break finally, after about the fourth or fifth test, we finally break over 1275, and that's when I got interested in a short here. Now, it got kind of close to 13, where we had this upper resistance level marked, before it really started selling off. Now, when it starts selling off, what do you have to notice at this point? Well, we've been bullish above the VWAP, volume weighted average price, most of the morning. Now we're sitting kind of heavy on it and going sideways. That's a bearish signal. And now, if you really want to wait for backside, you can get it on the snap of the VWAP as it's going sideways. 1250 is not a terrible average. As this thing sold all the way back down towards the whole dollar, right under the whole dollar, hit a bunch of stop orders and bounced right back up. And that's ultimately what VIAV did. Now, for those that buy the breakouts, what I would recommend on the long side is buying it off of this trend line at lows next to tight risk. So your risk is very tight on it. You're near VWAP, you're near the bottom trend line. So you're only risking 5 or 10 cents to make 30, 40, 50 cents. And then at that point, that's just a profit target. So you can set an adjusted stop with your leftover position at your break-even price. So you're either green or greener on the position. That's what I would recommend. I never recommend buying breakouts because of this. I've seen it so many times. When I first started trading, that's all anyone ever wanted to talk about was buying breakouts. The thing is, newer traders, they don't think about risk. They just think about breakout. And oh, I see this bull flag. Let's trade it. This is a green trade. I see this bull flag. No one else sees it. Everybody sees it. Everybody sees the bull flag. The stock's overbought. It's at resistance. Can it make newer highs? It can, and you can long it up towards the whole dollar like 13, which it may get through before it does this liquidity grab and elevators back down. But a lot of times, this is what I see, the fake out breakouts. And longs get caught, they go deer in headlights, the stock elevators down, it fades, and they're stuck in their position, adjusting their risk parameters mid-trade. Losers add to losers, or they go paralysis analysis and lose a huge majority of their account. I've seen it so many times. So what I like to do? Well, when I see something that looks like a good long, but it's at resistance levels, it's already overbought, then I see this level up here, and then I see this as an excess supply zone to short into, as longs are accumulating shares right there and ultimately going to turn into baggies. Now, does it work 100% of the time? No, but it does work a lot of the time. I've seen this very often. Just as the probability distributions that we talked about recently. Maybe think of an upside down triangle. 80% of the time it may work, but the other 20% is split up into less likely going to happen and then highly unlikely going to happen. What's the highly unlikely scenario? Well, maybe it gets a short squeeze. I didn't check the short percent interest of the float. It could have been very high. I don't know anything about this company. I don't really trade fundamentals. I call them fundamentals because normally it's somewhat superfluous as far as the price action goes on the ticker. Now, earnings does typically hold a ticker up more so than other kinds of news, and that's what we had here. So I consider that with this trade, that it may not work because it is on earnings, which may hold it up more so than some fluff news out there. But that's why you always predefine risk, because risk says more things can happen than will happen. That is a quick lesson on today. I figured we'd change it up. I've been doing live trading every single day for the month. Today, was a long day. I was red on a lot of tickers I traded today, and that's been the name of the game. I tried to reverse psychologize today and say, okay, we've been red with our first trade every day, so today, the first trade I want to trade, I'm not going to trade it. And still was red on a lot of tickers, but we've been stopping very well. I don't want to be the king of stopping out. I was green 6 days in a row, and then the last 2 days, I top tick my stops on 2 decent-sized losers, which hurt, and that's tough when you're trading with a small account and you have little margin for error. Now, I'm feeling very good because I've been letting these winners work for us. Could have let this one work more, actually. Took all of it at 12.30, and we ended up flushing all the way down, but I had a good average, like 12.75 was my average, and I took it all at 12.30. That was right around the open. Name of the game, could have held those leftovers a little bit longer. What we've been doing very well at is stopping out well, and I've been letting these winners work more than I typically do, so that's doing well for us. When your risk reward is appropriately set, you can have more red trades than green trades and still be green if you're leaning into your winners, which I was doing here, was working it, taking half off as it popped back up, shorting back into it, and just maximizing on the winning trades. That's what we've been doing well at. So traders, as we enter the weekend, I want to know how you did. Let me know in the comment section below how your week went and how you want February to start for you. What are some new rules you're applying to your trading account? We've applied plenty over here. Let me know in the comment section below, and if you like the recap or if you want to stick to the live trading, I'll probably be mixing it all in here and there, so just let me know, guys. Let me know if you have any questions. AveryDayTrading@gmail.com. We will see you guys Monday morning.